mates. Later CPA, later CPA, later CPA and Associates. Later CPA and Associates, accounting done great by mates. For all your tax needs and more,
Hi there, I'm Daniel Later, founder of Later CPA and Associates. Welcome back to our ongoing series, Building a Successful Private Practice, from Beginning to Infinity. What do a therapist and an accountant have in common? They both ask questions that make you sweat, but only one of them lets you deduct the pain. All right, so this week on our conversation, we're talking about planning for retirement, tax saving strategies. Now, we've talked about retirement stuff in the past. This is a little bit more in-depth view of it with tax strategies in mind. So you'll see the difference. But let's go ahead and get right into it. Now, first off, many therapists put everyone else's future first and their own last. That's the nature. That's part of empathy. But retirement becomes your future me problem. So the IRS, when it comes to retirement, the IRS will either be your silent partner or your silent funder. So the earlier you start to plan, the more you get to keep from paying away in taxes. So the goal for today is to show you some simple and realistic ways that we can build your retirement savings and reduce taxes using your private practice's income. Okay, now why does retirement planning matter for therapists? Well, many private practices don't have any kind of retirement plan or pension plan or 401k in place. I've seen that many, many times. Now, if you don't build your own retirement plan, no one else is going to do it for you. Now, a couple things to consider. Your income can be irregular, especially if you're a solo practitioner. You'll have a good month and then a much reduced month. That's the nature of it. So we need to find retirement plans that are flexible. And planning becomes even more important. Now, when you have a retirement account, there's two big wins that you get. First, you're building your long-term savings. You will thank yourself in 40 years that you've gone through the sacrifice to build your savings. And if we do it right, your retirement contributions will reduce both your current tax bill and your future tax bill. So keep that in mind. Doing it right is a benefit. Now, in reality, as therapists, you're going to have life changes. You're going to have health changes. You're going to have burnout that makes you want to stop, that either encourages you to stop working or forces you to stop working. That's life. That will happen. Now, you may not want to, but you won't be able to see clients forever. Meaning eventually your practice has to tone down and your earnings are reduced as well. That's why we do retirement planning. Now, just to go over some of the main types of retirement accounts real quick. I've covered these in past videos, but let's talk about them again real fast. First, the easiest, simplest, just a regular old IRA or a Roth IRA. They're real similar, but have a couple big differences. You can put money into these. This is a fantastic way to start. Very low costs to start, very easy to start. Go onto a broker's account. There's a bunch of them out there. If you have a financial planner, he should have already taught you to set up an IRA already. Do an IRA. You can contribute up to $7,000 each year. And if you're married, that's $7,000 per spouse. If you're over the catch-up age, which I believe is 50, you can put another $1,000 in, making the total $8,000 for each. Traditional IRA, when you put money in, you get a tax deduction now for this year for putting that $7,000 in. That's great. If you choose a Roth IRA, which actually has better long-term benefits, if you choose a Roth IRA, you get no tax deduction now. But in the future, when you're taking money out, with the traditional IRA, that's when you pay taxes. When you take money out. With a Roth IRA, you don't pay taxes when you take money out. Now, I'm simplifying it a lot, so keep that in mind, but that's the concept. Roth accounts, you pay taxes now, but you get the tax benefit in the future. Traditional accounts, you get a tax deduction now. You pay tax in the future. Now, IRAs, both the traditional and the Roth IRA, that's a fantastic option if your practice is still small. We can see more benefits from doing business retirement accounts, which we'll get into, but if you're still small, just still starting out, an IRA might be sufficient. Now, let's get into some of the business accounts real quick. First, my favorite right now is a solo 401k. It lets you make both an employer and employee contribution. They're still both coming from you, but they're two forms of contribution, which lets you put more money away into 401k sooner and faster than other options. With a solo 401k, you have the option of doing it as the traditional pre-tax method, still get a tax deduction for the contributions now, or you can use a Roth option, which, like we talked about before, you're not getting a tax benefit now, but in the future, you might get a much larger tax benefit. So, solo 401k, it takes some setup. Don't do it alone. I don't think you can do it alone. You'll need to use a broker or someone to help you set it up. An SEP IRA, it has some similarities to a 401k, except has some big differences. First off, you only make one contribution. Only the business contributes to a SEP IRA or a SEP IRA. There's no there's no employee contribution like a 401k. Only the business puts money in your SEP IRA. It's a lot simpler to set up than a 401k. You cannot contribute as much as quickly as a solo 401k, but if we're limited by a lot of things such as cash flow or what you're allowed to, or income limits, etc., it might be better to do a SEP IRA or a SEP IRA. They're a lot easier to set up. And just like the others, you can do a SEP IRA as a traditional or Roth option. Now, the last common business type of retirement account we'll talk about is a simple IRA. This one is different than the 401k or the SEP IRA, but it's similar to both of them too. This option works best when you have employees. The other options are fantastic when you have no employees, but fall apart quickly if you do. A simple IRA is built for businesses that have some employees. You can contribute, the employees can contribute to their own retirement, plus the business can also contribute to their retirement as well. You can contribute a lot less to a simple IRA than you can with the other options, but it is also very easy to set up a simple IRA too. So keep that in mind. Those are the three big ones: solo 401k, SEP IRA, simple IRA. And don't forget your individual accounts, an IRA or a Roth IRA. You can almost always still have those accounts when you have the other kind of accounts for the business. Now let's get into the strategy side of those types of accounts without taking too much time or getting into the weeds. So first off, we can make retirement contributions, and that decreases our tax burden for the current year if you're making the traditional contribution. Or you can take the other approach and make Roth contributions to decrease a future tax burden. Either way, you get a benefit for contributing to a retirement account. So keep that in mind. That's the first and the easiest strategy. Now, a little bit more complicated. Let's say you are able to make contributions both into a traditional and Roth accounts simultaneously. We have to keep in mind the limits, etc. They'll apply to both combined, so you can't put double the amount into both accounts. You're limited to whatever the total for that account is anyways. But you can make both traditional and Roth contributions. The benefit of this can be, let's say you're a business and your income is just too high, just slightly over the line, and you're phased out of some great benefits, some great tax benefits. Then in that case, let's use the retirement account. Let's edge you down just far enough so you're below the limiter of whatever benefit you're being phased out of. That way you can get the full benefit, and you're making just a little bit or a part of the traditional of the traditional retirement contribution into whatever kind of account it is. Then the remainder of the contribution that you want to make, put it in a Roth account. You've secured the benefit you want from a traditional, put everything else into a Roth. That's one strategy to use. It's a great one. It lets us have really fine control over your tax situation to make little incremental moves. Now, another strategy is coordinating with how your retirement plans fit in with your business structure. This is where we can get really complicated. We won't, but just keep in mind, whether you're an S corporation or you remain an LLC, PLLC without taking the S election, or you're a C corporation, whatever, those business structures affect how much you can contribute into a retirement account too. It's usually not a yes or no, black and white, clear decision. It's usually a lot more of a balancing act to see what benefits we want from, to see what benefits we get from making a certain business structure election versus what benefits we lose from doing that. So we have a balancing act. We can usually put you in a better situation than you would be automatically. So that's one of the more complicated ones. I'm not going to go into details because it's hard and it's more of a case-by-case basis. Now, also, another strategy we like to use is make your retirement an automatic expense, meaning set it on autopilot, let it run. Then you don't have to worry about it or think about it or wait until the end of the year and think I could potentially put away $20,000, but I haven't saved $20,000 to do that. So putting your retirement on autopilot, automatic for the year, that helps to get it done. Smaller amounts over a longer period of time versus one big amount all at once. Now, when we talk about retirement and tax planning, really what we're talking about is, what do we want in the future? What do we want after we retire? What do we expect our needs or our family's needs will be after we retire, or when we start to slow down or ramp down our practices? So keep that in mind. We have to look at retirement with the end in mind. If you anticipate that your needs will go way up when you're 80, 90, something like that, and you're going to need a lot more money, then that's going to influence how you structure your retirement now. Or if you anticipate the opposite and you think, well, once you retire, you've got your living arrangements paid for, you have the children who already want to take care of you into your 80s and 90s. If that's the case, and you don't have a need for a really big retirement nest egg, then let that adjust your strategy. So we want to make plans with the end in mind. What do we expect? Obviously, we can't predict the future. Obviously, it's better to overestimate than to underestimate. So overestimate that, but you still have in mind what things might look like in the future. Also, keep in mind, don't do retirement planning by yourself. This is not a DIY project. I'm all in favor of doing DIY things, but not when there's so many factors that interplay and so many rules that come together too. If you don't already have a if you don't already have a financial planner, get one, find a good one. They will help you. If you don't already have a CPA or a tax strategist, find one, get one. They will help you. And in my experience, both professions are more than happy to work together to make the best outcome for you. But don't do it alone. There's a lot of things you can miss. Don't do it alone. So, one last thing to think of. And one thing to keep in mind. If you kept practicing at your current pace, at your practice for the next 10 or 15 years, would your future self feel supported by the money you're setting aside today? Or would they feel like you've abandoned yourself? So keep that in mind. Now, if you have any questions about this topic, feel free to reach out to me, DM me, email me, etc. I'm happy to answer any questions. If you would like to schedule a free 30-minute discovery call where we talk about your business, your tax strategies for your business and yourself, and anything else you need to, go ahead and DM me. We'll send you a link for a discovery call and we'll talk about your business for 30 minutes for free. Don't forget, follow and subscribe for future tax events like this one or other tax tips we share, and visit our website, latercpa.com, latercpa.com. I will see you all on the next video. Have a great weekend. Keep helping others to help themselves, and let us help you to do just that. Bye.
For all your tax needs and more, Later CPA's the one you adore. Later CPA and Associates, accounting done great by mates. For all your tax needs and more, Later CPA's the one you adore. Later CPA and Associates, accounting done great by mates.